Yo, what up, everyone? Hope everybody had a good weekend. What's going on? What's going on? Everybody hears me good? What's going on, everybody? Hope everybody had a good weekend. Just make sure everybody gets in here before I get going. Cool, cool. I'm loud and clear. Cool. All right, yeah, I never did one of these YouTube lives before. We usually do webinars similar to this, every Sunday for members of Trade, but this market is slowly transitioning, at least the past week or two. And I got a lot of messages on Instagram this weekend just about people, struggling. They took maybe some big losses last week. And I kind of want to touch into how to adapt to the current conditions, what I'm looking out for, and just changing your mindset a little bit to adapt and react to what's going on kind of in the market. So I laid a little intro of everything that I'm going to go over. So these are the main points of this webinar. And then right after this, I'm going to get into a live charting webinar for Trade members. And I'm going to go a little more in depth. So if you aren't a member of Trade, check out the links below. As soon as I end this YouTube, should take about a half hour. We're going to get right into the webinar that we usually do on Sundays. But I just want to first go over and just say that primarily I'm going to go over ES and NQ. You all know these are my favorite instruments to trade. The concepts I'm going to explain in this live all are going to relate to no matter what equity, no matter what market you trade. You trade Apple, Amazon, Tesla, you trade crypto, you trade Forex. The concepts in the market with price and volume analysis will apply no matter what you are trading, what you are looking at. All the concepts apply. It's a market just like any other market. So the first thing I want to get into is adapting to the current market conditions. This is very, very key because I know a lot of traders just started getting into trading, whether it be the past 3 months, whether when COVID first started, whether it be the start of this year, whatever it may be. With screen time and experience, which is probably the best thing that any trader could do to develop this relationship with price and volume that I always say, with screen time and experience, you recognize different markets, you trade different conditions, you trade volatility, you trade not volatile markets, you trade large price swings, you trade news. So with this experience and screen time, your eyes, whether you realize it or not, subconsciously you get adjusted and you start seeing different things that you may have seen in the past. And this response goes off in your head. You recognize these conditions and you could trade accordingly to that. So the new traders are kind of going to struggle this week or struggled last week because they aren't used to the conditions that we have been seeing. Now I'm going to post this on my Instagram later in the week. I already made the post. But if you look at just the volume down here, let me make this a little bigger. If you just look at the volume from the start of December, maybe the last 2 or 3 days of November, obviously we started to see an increase in volume. Now that's very good because when there's an increase in volume, you are going to see an increase in price movements. Increased volume usually, and it's a good sign, leads to larger price swings. Now this is different from what we have been seeing. Let's just call it back in middle of October, late October, where the market just kept moving up. We kept creating demand, pulling back into demand, and then rallying to the upside. Now, this has been done on lower volume. So these conditions, right where I'm hovering over right now, I could even draw a little line for you guys, is going to be different from what we've been seeing in the past 2 weeks. Now, if you trade the same way you would have earlier in October, November, you would have got destroyed last week. This is why I always stress it's very key to react to what the market gives us and adapt to the conditions. So the point of this video is trying to get you all to understand what I mean by adapting and how to trade these conditions if they are here to stay. If they're not here to stay, you all will be prepared at some point in the future because these are cycles that the market constantly goes through. So this rally in October was on very, very low volume compared to what I would like to see. Even back in May, June, July, every single move down got bought up. I remember all the time, every week in the Discord, the market would pull back. And I would tell members, this is just a normal pullback. It happens. It's going to get bought up. We're bouncing off demand. And then the market continues to rally and we blow past supply. Supply zones have been reliable for short-term scalps, playing counter trend of the overall larger time frame picture, higher highs, higher lows. However, it's going to come to a time where those demand zones do not become very reliable because a lot of these areas that I consider not very key imbalances are going to get destroyed when the market has an agenda to move down. What I mean by this is let's just act like it's the start of November and the market's rallying. Everything's good. The market, we think we're going to hit 5K on the S&P 500. Just every day is a gap up. Every day is a rally and the pullbacks get bought up. This was done on such low volume and really no solid aggression to the upside. The whole premise of price and volume is you want to see aggression. You want to see fast, volatile movements in either direction. And if we're talking about the buyers or the demand side, you would want to see a strong rally or a strong move up to the upside. This whole rally right here of my trend line, there was really nothing of that. Yes, we had some very strong green days that we closed near the highs, but there really isn't any strong aggression other than this pullback right here. Keep this in mind. This pullback right here got bought up after about a month of lower lows and lower high action. This could be, similar to what we're seeing right now. We don't know just yet, but I'm just reacting to what the market's currently giving us. So after this is going to be a key inflection point. After that, we got that move up. I would have liked to see this rally to the upside show a little more aggression to a very strong move to the upside, somewhat similar to, this where we strong move up, and continuation after those strong moves up. This was, if you were watching the action back in November, October, it was just very slow and it was very difficult to catch some volatility and some volume coming into the market. So because of this, I've been saying every single webinar, Investor Trade members could even quote me, probably the past 2-3 months, that when the market does want to pull back, the demand zones in the area of this rally from October to November, these demand zones, I deleted them now because we came below it. So a good rule of thumb is if we break below demand, I remove it. It just removes clutter from my charts. But all these demand zones that were created, I'm just randomly placing lines here, on the move up, got completely destroyed last week. So now the market's slowly transitioning to the volatility, and it's slowly transitioning to a shorter time frame, immediate trend of lower lows and lower highs. And if you were to see, I'm going to remove these lines now. If you were to see on the daily chart, every day we put in a lower low, a lower high. And the days after this middle candle right here, we tried breaking above the previous high, but failed. Failed over here, and Friday's action was a little weird, but we're going to get into that. But these demand zones, I've been saying it for so long, are not going to be very reliable. So last week, if we are trying to long off of demand, we are going to get destroyed. This is where market context comes into play. I say it in all my videos. There's a full section in the course about it. Market context is key. Technical analysis is not definitive. It's not if you see this, you're going to get, if you see X, you're going to get Y. It's more like when you see X, you see Y, and we react to Z, we're going to get a result in that kind of manner. So just because we see something, for example, coming into demand doesn't mean we're going to bounce. You have to add market context. In an uptrend, supply zones are good areas to take the market or to take profit off of your long positions. And then pullbacks into demand are good areas to open up new long positions as long as we find buyers down there and buyers find value at supply. So now going to a more of a short-term picture here, you could obviously see lower lows, lower highs, right? So now the market moves down, and this is where context comes into key. How are buyers and sellers defining this auction? What I read from this is the market tries putting in lower lows and lower highs. Every time we move up, we fail. Come back down, we try to move up, we fail. We move back down, break below the previous low, move back up, we fail at supply. It's just a common theme. So when I see this type of action, especially with the context of these demand zones in this area right here not being very reliable, I am a little hesitant to the long side on being a first buyer. Also, with the current context, this is going to apply to NASDAQ as well. I'm just going over the S&P, but this is going to apply to the NASDAQ as well. It's the same, pretty much the same chart. We broke above the daily high. We failed. We got some absorption near the highs, some nice selling pressure, and the market moved down. That was similar or a good sign of a first red flag, especially when supply formed near the highs. And back on Wednesday, November 24th, we rejected it. And the following day, we had a very large sell-off. I think that was on COVID news, but don't quote me exactly. So now we're starting to see a little different action where supply has been a little reliable and the demand zones are not very reliable. Strong supply forms. That is a good sign that sellers are stepping in, especially when rallies get sold into, and especially when key supply zones form where the move to the downside is very aggressive. This is something that you want to see right here, showing aggression. The market spent little time in these areas and they didn't find acceptance at these prices. The market started moving back down, we rallied back up, and it failed. So now, rallies into supply are good areas to maybe look to take the market short and take profit inside of demand. The switch kind of flipped from back what we've been seeing 2 weeks ago. Maybe open up a short position if we don't find buyers at demand. I could show you, let me go here, invalid zones. So like I said earlier, I could show you 100 different demand zones that we had in this area, which really were not very strong. That we got completely destroyed. For example, this day right here, I could draw 100 different zones. It got destroyed. I'm just, randomly plotting them. But if we don't find signs of buying at demand right now, it is a avoidable trade to not take it to the long side. How I'm going to play this is if we do not find buyers at demand right now, I'm going to possibly look to open up a short position as long as buyers do not step in and as long as we reject supply to the upside. I don't want to be shorting a key demand zone either. How I define the key demand zone is one that is used, one that has caused a very aggressive move to the upside, or something that the market really had a hard time agreeing with. Another good example, Friday on the NASDAQ, we sold into these demand zones and found 0 bids into the market. So now these all become invalid. I'm not interested in these. I'm not trading off of these. And now we came and closed inside of a very key supply or a very key demand zone. Now going back to the S&P. Supply forms near the highs. Supply forms up here. These are all areas of interest moving forward to this week. I'm not going to spend this webinar charting my exact areas. I actually haven't even charted new zones. I'm going to do that in the webinar after this for members. But all supply zones to the upside are on watch to short. And I'm watching the reaction at demand zones to possibly take the market short if we do not find signs of buyers at demand. Okay. Now, that was adapting to the current market conditions. I went over the current market context. Now I want to go how to trade in volatility. This is where a lot of traders struggle with because they think the market yesterday is going to be the same as the market today. Is everybody following along so far? I don't want to lose anybody. Just let me know if you're following along. You guys are following along? Cool. Okay. So that's that. So how to trade in volatility. It's much easier to get large price swings with volatility, so you do not need to trade large size. Probably the number one cause of traders blowing up accounts is because they trade with large size and they do not respect their risk. You have to respect your risk when you are wrong on the chart. No one is going to be right 100% of the time. If you are going to take losses, I take plenty of losses. Everybody takes losses. So the key is making your losses small, respecting your plan, respecting your risk, so you could live to fight on for another trade. Now, a lot of traders do not size properly. I will say, if you have not been consistently profitable for at least 4 to 6 months, I don't care if you have a $100,000 account. You should be trading with one contract only, or 1 to 3 contracts, let's just call it, so you can get better with small size. Trading is very, very scalable, meaning I don't care if you have a $100,000 account or you have a $1,000 account. The process is still the same. The only difference is, instead of buying one contract or 2 contracts, now you buy 100 contracts or you buy 300 contracts. It's the same exact process. People go in with large size, they become emotionally attached to the market, and when it goes against them, they can't sell because they can't stomach such a big loss. So when the market is volatile, tomorrow we could have no volatility, it could be dead, or the rest of the week it could be dead. But these conditions, when volatility is present, you could even see it. Look on a 4-hour chart. Look at the past week and a half of volume compared to what we saw back in that uptrend. I mean, it's just significant that it's, obvious that volatility is back. So I don't care if you have a $100,000 account, $1 million account. If you are learning and you haven't been consistently profitable for 4 to 6 months, trade with 1 to 3 contracts until you could prove to yourself you're consistent with that, and then you scale up. I had somebody in my messages on Instagram this weekend, they took a huge hit because they were going in with full account size and they didn't even have a stop loss. They fell asleep and they woke up to half their account gone. That's just stupid mistakes that can be avoided. I don't want to see anybody take a massive loss off of something that could have been avoided. Okay, so trading in this volatility. Since we are getting large price swings, it's okay to trade smaller size. Let's say your normal position size maybe is 10 contracts. Maybe go to 5 contracts now because we are getting, look at this, a 100-point drop on the S&P 500. If I were to pull up SPY contracts, let's just act like we shorted this supply zone at 4,600. I did not take this trade, but let's just say we did. We played the 459 puts, and we played Friday's expiration. Maximize this, unlink this, put this here. I guarantee you these puts exploded. Okay. Yeah, the 459 puts went from a low of $1.25 to a high of $10. That's 1,000% return, let's just call it, from this sell-off. So let's just say we trade 10 contracts, right? Our normal size 10 contracts. This trade would have yielded us $9,000 profit if we sold from low to high. No one's ever going to sell low to high. But if we were trading, let's just say 5 contracts, right? We're short at supply. We're trading 5 contracts. We get a quick move. These contracts moved from $1.25 to $4.68 in a 20-minute period. That's a 300% return in 15-20 minutes. So instead of going with 10 contracts, and because of this volatility, a quick pullback or a quick rally like this is a 20-point rally. This doesn't look like much right here compared to what we have been seeing. But this 20-point rally right here, most likely if you guys are shorting near the lows and your risk to reward is skewed, this pullback is going to destroy you. And if you're trading with large size, a 20-point rally like this is definitely going to stop you out if you don't implement proper risk management. So to combat this, trade with smaller size. Number 1, your emotions aren't going to be doing the trading for you as much. And number 2, you could stomach a quick rally like this, that the trend is still in play. Whereas if you're watching with higher size and you're watching your P&L, you're going to get scared and you're probably going to stop out of this trade, most likely near the highs. I've had it happen to me where, I buy at the low or I short at the low and I stop out at the high, and then immediately my trade starts working out as soon as I stop out. It's happened before. So trading this volatility, smaller size. I'm actually going to write this out for you. Smaller size plus wider stop loss. When the market is less volatile, you can trade, this is how I do it, larger size and then a smaller stop loss because the price movements isn't so volatile. We're not making crazy moves. But when the market drops 100 points in a day, I'd rather get 20 of those points on 5 contracts instead of trying to make 100 points on, maybe 1 contract or whatever the case may be. If I said that backwards, excuse that, but we're getting large price swings. There's no reason to fully leverage into your account. We're getting crazy moves. If you trade options, they're going to explode. No reason to swing for a home run. In fact, you need to play defensive in this market. If you don't play defensive, you are going to get destroyed. So volatility is good. Honestly, these are the conditions that I trade very well in. I make probably the most amount of money in these conditions just because of how fast everything moves. Works very well with supply and demand. Works very well with how I like to trade. Yeah, so that's that. What else did I want to get into? Okay, how do I plan in the upcoming days? I said it earlier, but how I plan on trading is right now. Now, this could change. I'm going to go over my plan in the next webinar. This could change, but right now, before the market opens up tomorrow, I could have a completely different mindset when I wake up tomorrow morning. This is what's key, is reacting and adapting. Right now I could say something, but tomorrow it could be completely different because I react to what the market gives me. A lot of people go to sleep, they plan, and they let that kind of like a statue, and they put it in stone and they put it in writing, and they don't bend a little bit, they don't react, and they don't adapt or change something to what the market gives them. So right now, what I'm looking for is shorting rallies inside of supply, and I will continue to short rallies inside of supply until buyers find value at key supply zones. What I mean by this, very similar to what we saw back in November. Let's just act like we had supply over here. 2 days after we came into it, buyers found value at this point. At this point, I'm not looking to short the supply zone. Instead, I'm looking to get the market long. If that is the case, my thoughts will change about shorting rallies inside of supply. Every single rally we saw last week failed, and especially a high quality one comes at supply. So I'm looking to short if that's the case, and I'm also looking to short if lower lows could be put in and lower highs could be put in. This 4,500 mark on ES, if you trade SPY, is very key, and the same applies to the NASDAQ. Lower lows, lower highs. I'm going to continue to short failed rallies as long as sellers step in at supply. I get my confirmation. I look to take the market short. My risk is very small. And with these large range movements, my risk is defined. Now, I will switch to the long bias. If this $4,500 level bounces, if we hold it, we bid above it, I will say I am not looking to long the market as a first buyer with all these demand zones lower not being very reliable. What I mentioned earlier when the market sold off was how unreliable those demand zones were. So what makes me think that the next demand zone we have is going to bounce price? Yes, it's possible. I will never say that it's not possible, but I rather, from a percent chance of the trade working out with such weak context, I rather miss the bounce off of demand, and I rather wait for a retest. It's what I call being a first buyer in the market. I rather let it bounce. For example, I didn't take this trade long going into the close on Friday on the S&P. I let it bounce, and what I would rather this thing to do is let it bounce, maybe come back, retest the demand zone, buyer step in again, and then I could take the market long because my risk is even more defined. Or I'll let new demand form in this area, let's just call it. We pull back into the new demand and we bounce off of that new demand and a higher low gets put in. Then I'm okay with taking it to the long side. But I don't want to see anybody take a trade at demand, A, without proper confirmation, and B, catching a falling knife. If you look, this is just a mini pullback on the chart. No one's sweating. No one's calling it a bear market. No one's calling the top. All I'm saying is react to what the market gives us and trade what the current market context is. Adapt and react. It's so key. Okay. And like what I said earlier too, I'll only play it to the long side. I'll only play long at supply or near supply as long as buyers find value. Maybe we slice through supply, we create volume inside of it. I just want to see some type of buying activity at supply, which is going to be different from what we normally have been seeing as sellers have been stepping in at supply. So I hope that makes sense so far. I don't want to see anybody take, of losses that could have been avoided. 90% of the trades that we take and we lose on are ones that we make our emotions do the trading. We can't let our emotions step in the way. We can't let our ego think, oh, I know what's going to happen. I don't try to predict what's going to happen next. I just react to what the market gives us. And then you put your trade on, you respect your risk. And if it works out, it works out. You make money. If it doesn't work out, you don't sweat it. You don't, get mad at yourself. You journal it, you learn from it, you review it, and the next opportunity could be the best opportunity. So that's kind of where I'm going with this. Another thing I would like to bring up is when the market is like this, I just said it earlier, I make the most amount of my money trading SPY and QQQ off of the ES and NQ charts. I just love trading this type of action. And a lot of the major market leading equities are going to do, and they're going to mimic the ES and NQ chart. So if you're looking to trade an equity, for example, Apple has a beautiful setup, let's just call it, or Amazon has a beautiful setup coming into demand. If the market's weak, I don't care. I'm not interested in trading it unless the market's strong or the market's also bouncing off of demand. So we have very key demand imbalances below. The S&P has this very key 4,500 mark. And this area that I circled earlier, this is going to be very key if we break 4,500, that we have to hold this imbalanced period right here. Very key. And this is probably going to decide what's going to happen next. If the market moves back up tomorrow, we create value inside of supply. We find buyers. Maybe we create demand or put in a lot higher low at demand. Then my thoughts will slowly start to change because I'm just going with the flow of the market and I'm reacting to it. So if you guys have any questions, just let me know. Feel free to reach out. Follow me on Instagram. If you have any questions, just catch up with the chat. I hope this helped. I can start doing more like this, but I'm going to wrap it up. I'm going to do a webinar for Investor members right after I end this one. I'm going to hop on the live stream tab on my website. If you are a member, head over to that in about 3 to 5 minutes. And if you aren't a member, check out the links in the description below. Join the family. It's a very active, very good, engaging community. We do webinars like this all the time. I send pre-market plans in the morning and commentary throughout the day. So I'm going to end it. I hope you all enjoyed this live stream. I hope you all learned something, got some value out of it. If you did, drop a like, comment any questions, and reach out. But I'm ending it on that note. Peace out, everybody. Have a good weekend. I hope you enjoyed the weekend, and let's